Hi, my name is Muhammad Razin, and today I'll be presenting on the topic Introduction to Shari'Ah Principles Governing Commercial Transactions. This topic focuses on the key principles that guide how business and financial transactions are conducted under Shari'ah, emphasizing ethical practices, fairness, and transparency. These principles form the foundation of Islamic banking and help explain how it differs from conventional banking. This presentation will focus on three main areas. First, the fundamental differences in principles between conventional and Islamic banking. Second, how these principles reflect ethical and professional conduct in financial dealings. And finally, examples of banking practices that demonstrate these differences in a Malaysian context. So, what is an Islamic banking? Islamic banking is a Sharia-compliant financial system that bans interest, riba, and focuses on ethical asset-backed deals. It uses profit and loss sharing like mudarabah, capital partnership, and musyarakah joint ventures instead of regular loans. This trillion-dollar global industry avoids haram sectors like alcohol or gambling. But what about the conventional banking system? Here it is. Conventional banking system operate on interest-based lending, where banks profit primarily from charging fixed interest in column riba in Islamic terms on loans and paying interest on deposits. Unlike Islamic banking, they emphasize debtor-creditor relationships, with the borrower bearing most risk and no strict limits on investments. This model drives global finance but can lead to debt cycles, especially in economic downturns. So, what are the principles of Islamic banking? Don't worry, these are the answers. The first one is the absence of interest-based riba transactions. The second one is the avoidance of economic activities involving oppression zone. The third one is the introduction of an Islamic tax zakat. The fourth one is the avoidance of economic activities involving speculation, uncertainty, gharar. And the fifth one is the discouragement of the production of goods and services which contradict the Islamic value, haram. This slide shows the fundamental differences in principles within conventional and Islamic banking. Although both operate under Bank Negara Malaysia, their core philosophy is very different. I will start with conventional banking principles. Conventional banking earns profit mainly from interest. For example, when a customer takes a home loan at 4% interest, the bank earns interest regardless of whether the customer makes profit or faces financial difficulty. And the second point is risk approach. In conventional banking, most of the risk is borne by the bank, while the customer is required to repay a fixed amount. For example, if a customer's business fails, they are still obligated to repay the loan plus interest. And number 3, ethical or regulatory framework. Conventional banks focus on legal compliance rather than ethical screening. For example, as long as the business is legal, such as gambling or alcohol-related business, a conventional bank may still provide financing. Now, I will move on to Islamic banking principles. Islamic banking earns profit through trade, leasing, or profit sharing rather than interest. For example, under murabahah financing, the bank purchases an asset, such as a house, and sells it to the customer at a markup price. And the second one is risk approach. Islamic banking is based on the principle of risk sharing between the bank and the customer. For example, in a mudarabah investment, both parties share profits, and if losses occur, they are shared according to the agreed terms. And the last one is ethical Shari'ah framework. Islamic banking must comply with Shari'ah principles, which emphasize ethical and halal activities. For instance, Islamic banks do not finance businesses involving alcohol, gambling, or pork-related products. Islamic banking in Malaysia builds ethics and professionalism by following Shariah rules that ban interest, uncertainty, and unfairness. This makes banks act as partners, not just lenders, unlike regular banks that focus on fixed profits. Shari'Ah principles prohibit riba or interest, which means Islamic banks cannot simply earn returns without sharing risk. As a result, banks are encouraged to structure their fair deals with clear and transparent terms. In Malaysia, every Islamic banking product must be reviewed and approved by the Shari'Ah committee. This creates a strong culture of professionalism where bank staff are trained to follow ethical guidelines and avoid misleading practices. Unlike some conventional sale-driven approaches, shortcuts and aggressive selling are not acceptable under Shari'ah governance. Banks collect zakat, charity tax, and skip sectors like alcohol, pushing staff to think of community good. Conventional banks chase borrower credit scores and add big penalties on late payments. Now, let's look at how Islamic banking practices in Malaysia promote ethical and professional conduct compared to conventional banking. In Malaysia, Islamic banking stands out mainly because it avoids interest and emphasizes risk sharing. Instead of a one-sided lending relationship, the bank and customer work more like partners. This creates a sense of fairness and shared responsibility, especially during difficult times. For example, in home financing, Islamic banks such as Maybank Islamic use murabaha. The bank first purchases the house and then sells it to the customer at a price with a clear profit margin. The key point here is transparency. The customer knows the total cost upfront and it doesn't change later. In contrast, conventional home loans charge interest on the loan amount. If payments are late, the interest continues to grow, which can increase the customer's burden over time. From real experience, in places like Terengganu and Kuala Lumpur, during periods such as COVID-19 or floods, Islamic banks were more flexible, offering rebates or restructuring, while conventional loans often continued penalties. Let me give a business financing example in the Malaysian context. Under Islamic banking, banks like CIMB Islamic use musyarakah. For instance, if a shop expansion costs 200,000, the bank may contribute 40%, while the entrepreneur puts in 60%. Profits are then shared based on an agreed ratio, and if the business fails, losses are shared according to capital contribution. This reflects ethical conduct because the bank doesn't shift all the risk to the customer. In contrast, under conventional banking, a 200,000 business loan at a fixed interest rate must be repaid regardless of the business performance. Even if sales drop, the borrower still carries the full burden, while the bank's return remains protected. From real experience in 2020, a small trader in Bakar whose crops were damaged, under Islamic financing, the bank restructured payments and absorbed part of the